As startups scale and raise venture capital, governance becomes a critical aspect of company management. One of the key ways to ensure strategic oversight and investor alignment is through the board of directors and advisory boards. A well-structured board helps guide the company through complex decisions, fundraising, and operational challenges, while an advisory or scientific board provides specialized expertise without the governance responsibilities of a formal board. Understanding the role and composition of these boards is essential for both founders and investors as they shape the company's strategic direction, governance, and long-term success. The board of directors plays a critical role in a startup by acting as the company's governing body. Their responsibility is to oversee executive leadership, ensure that the company operates ethically, and make key strategic decisions that influence the company's growth and direction. When a startup raises venture funding, investors often request a seat on the board to protect their investment and provide valuable guidance. This shift changes the dynamics within the company since founders no longer have complete control over major decisions. The board is tasked with several important duties. One of their key responsibilities is approving major financial decisions such as fundraising, acquisitions, and setting the company's budget. Their approval is crucial to ensure that these decisions align with the company's best interests and those of its shareholders. They also have the authority to hire and fire the CEO, a decision that directly impacts the company's leadership and direction. In addition, the board helps set company strategy, guiding the long-term vision and offering input on key business decisions. They are also charged with ensuring fiduciary responsibility, which means protecting the shareholders' interests and making sure the company is managed in a responsible and ethical manner. The board also oversees equity and stock option plans, approving stock grants and employee incentives to align the compensation structure with the company's long-term goals. Typically, the board meets quarterly, but during crucial moments, such as major fundraising rounds or shifts in strategy, meetings may occur more frequently to provide input and make key decisions. For founders, bringing in a board can change the decision-making process, but it also offers an opportunity to gain valuable perspectives from experienced individuals and ensure that the company is moving in the right direction. While investors now have a voice, the collective guidance of the board helps protect everyone's interests and positions the company for long-term success. As a startup grows, the composition of its board changes. In the early days, it's typically just the founders calling the shots, but once outside investors come in, the board expands to reflect the different interests and expertise needed to guide the company. At first, you'll see founders and executives on the board representing the company's vision and execution. The founders are the ones driving the company forward, so their seats are crucial. As the company raises more capital, investor directors join the board. These are typically VCs who hold preferred shares, ensuring that the investors' interests are well represented. An interesting part of the evolution is the addition of independent directors. These are neutral industry experts brought in to provide unbiased advice and to keep the power dynamic balanced. They help steer the company with strategic guidance from an external perspective, which can be invaluable when facing difficult decisions. For example, after a Series A round, the board might include a CEO-founder leading the company's vision, a co-founder/executive helping shape the strategy, and investor directors who represent the venture capital firms involved. Then, an independent director might join to bring an objective voice to the table, helping resolve any disputes or tiebreaker decisions between the founders and investors. Independent directors are particularly important because they ensure that the board's decisions stay fair and balanced. Investors often push for these independent voices to avoid any one group, whether it's the founders or the investors, having too much control. This balance helps guide the startup in the right direction without skewing too much in favor of one side or the other. An advisory board is different from a board of directors as it doesn't have formal governance authority. Instead, its members offer valuable strategic guidance, industry expertise, and help make key connections that can support the business. Startups typically form advisory boards to tap into the experience of senior executives, mentors, and potential investors. These experts provide advice on important areas like business strategy, hiring, fundraising, or product development. Another reason to set up an advisory board is to gain some credibility. Having high-profile individuals on the board can help with networking and open doors to new opportunities. Advisory board members are typically compensated with small equity grants, usually ranging from 0.1 to 1% ownership, but they don't have voting rights like members of the formal board of directors. Essentially, they play a crucial role in offering insights and introductions, but leave the decision-making power to the company's formal leadership and board. For startups in industries like biotech, AI, or other highly technical fields, having a scientific advisory board, or SAB, is essential for product validation and establishing credibility. These boards are especially common in areas like biotech and pharma, where they help ensure that the company's research complies with industry standards, clinical trial designs are robust, and the integrity of the research is maintained. In AI and deep tech, the SAB plays a key role in guiding the development of algorithms, making sure ethical considerations are accounted for, and ensuring the technology is applied correctly. For startups in nature tech or energy sectors, the SAB can provide advice on things like regulatory compliance and the sustainability impact of the company's work. The members of a scientific advisory board are typically well-respected researchers, academics, or former executives from top universities, research labs, or major corporations. Their role is to validate the technology, assist in securing grant funding, and give the company credibility when pitching to investors or seeking regulatory approvals. Essentially, the SAB helps the startup build trust in its technological claims and strengthens its position in a competitive market. As a startup scales, the composition and dynamics of the board become increasingly critical. Investors should take a strategic approach to board structuring to ensure they have the right level of oversight, influence, and expertise to support the company's growth. One of the key considerations is selecting the right board members. Investors with operational experience and strong networks can add significant value beyond capital. By providing strategic guidance, facilitating key introductions, and leveraging industry insights, the right board members can actively contribute to the company's success. Maintaining a balanced board is also crucial. While investors want to protect their interests, an overly investor-controlled board can lead to friction with founders. Striking the right balance ensures that investors have sufficient influence without stifling the founder's ability to execute their vision. Bringing in strong independent directors is another valuable strategy. Experienced operators or industry leaders can provide objective decision-making, mitigate conflicts, and offer insights that neither founders nor investors may have internally. Their presence can improve governance and enhance overall board effectiveness. Lastly, keeping the board at an optimal size ensures efficiency. A board of 5 to 7 members is generally ideal, as it allows for diverse perspectives while maintaining agility in decision-making. Too many members can lead to bureaucracy and slow down critical strategic moves. While investors naturally seek board influence to protect their stake, structuring a well-balanced board is key to long-term success. Ensuring that governance supports both investor interests and company growth ultimately leads to stronger alignment and better outcomes for all stakeholders. The right board structure can be a significant asset for venture-backed companies, offering valuable insights, strategic guidance, and alignment with investors. However, if the board becomes too heavily weighted with investor representatives, there's a risk that founders may lose control of key decisions, potentially affecting the company's direction. An effective board is one that fosters collaboration between founders, investors, and independent advisors. This partnership should focus on driving growth, ensuring governance, and positioning the company for long-term success. VC investors who recognize the importance of board dynamics not only help strengthen a portfolio company's foundation, but also set the stage for smoother future fundraising, more informed strategic decisions, and ultimately, successful exits.